Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
There's so many things to love about owning rental properties, and one of the great benefits that we get as rental property owners are some really generous tax benefits. I've got a bonus episode of the podcast for you today, and we're going to explore one of these great benefits. It's called real estate professional status. This is really cool. If you follow the laws and you do things right, it's possible to greatly reduce or, in some cases, even eliminate your taxes. Now, there's a lot of little gotchas. There's a lot of little things you got to figure out. And on the show today, we're going to get to the bottom of it. We're going to figure out exactly what we need to do. Joining us on the show today for a repeat appearance is Ashish from InvestorFriendlyCPA.com. And Ashish is going to walk us through this. He'll explain to us exactly how it works and how we can legally reduce our taxes. Let's take a really quick break. We'll thank our sponsors. We'll come right back and we'll talk to Ashish. I want to let you know about a really easy way to track your rental income and expenses. It's an accounting software custom made for rental property investors. It takes just seconds to enter an expense or to record that you collected rent. It makes tax time really easy. Just run a report and give it to your tax person and you are done. They're currently offering a free 30-day trial. There's no credit card required, so if you don't like it, there's nothing to cancel. You can learn more and sign up today at rentaltrial.com. That's rentaltrial, T-R-I-A-L, rentaltrial.com. Before we get into today's conversation, I just want to point out we're going to be talking about things in general terms, and the tax law can be very complicated, very nuanced, and you definitely want to make sure that you talk to your own CPA to look at your own situation before you do anything. With that being said, Ashish, why don't we start off defining what real estate professional tax status is?
So, real estate professional status is a tax status that helps you convert a passive real estate activity to non-passive activity. So, and the rental is an important keyword here. I'm not talking about flipping. I'm not talking about you being an agent. This status helps you convert your rental passive losses and even income to non-passive income. And why is this important is, first of all, if you can, go through all these rules and qualify as one, you can use losses to offset your other income. On top of that, you also avoid the Obamacare tax. If you can structure this correctly, you avoid almost 4% of extra tax on your rental income if you can structure the status and your investment correctly.
I think to make sense of this, and this can be complicated, but we're going to try to make it really simple here today. But I think to make sense of this, the first concept that we need to get down is that there's really two buckets of money. Can you explain the way that those two buckets work and how income is taxed differently?
Absolutely. So that's a good starting point. I want people to understand, basically there are passive activity and non-passive activities. And we hear people say active income. That's technically not correct. You either have a passive income or non-passive income, right? So why is this two bucket and why do we need to know them to understand the taxation is you cannot offset passive, or I should say, you cannot offset or mingle these two buckets. So if you have a huge passive losses, you cannot use passive losses to offset your non-passive income. So that's the whole purpose of these two buckets, and it was put into the place to help avoid the abuse by this big high earners. Before 1986, they would use these passive losses through real estate and various other businesses to offset their W-2 income or other business income. So it was separated. law in 1986.
Okay, so just to make sure that makes sense to everybody. So bottom line, if you lose money on a rental, you can apply that loss to your W-2 income.
Yep.
Okay.
If you have a, and that's how the depreciation works in rental, right? If you have a huge loss and if you harness a huge loss on your rental activity, you cannot just use those losses to offset your W-2 income. That's the goal, and we can make it happen with correct planning, but normal rules, you cannot.
Right. Okay. Yeah. And I think that's the whole point of this show here is that we're going to show you how you can take those rental paper losses and basically erase your W-2 income.
Absolutely.
Right. Okay.
And I do want to add one more thing on that. And we hear people talk about how can I convert my rental passive losses to non-passive and offset my W-2, right? That's possible if you can eventually qualify as a real estate professional. However, not everyone can qualify. It's a very strict rule, right? So what we do for some of the other high net worth individuals is we do reverse planning, meaning that we take their non-passive business activity and convert them to passive so they can use those passive losses from real estate. Again, it has nothing to do with real estate professional status, but I want to let people know that there are other strategies if you do not meet the status.
Okay. All right. So what makes an activity passive?
Yeah. So, and this is a very important point, Dan, because once you understand this, it gets a lot easier and you can build on this. Let me give you an example. Okay. Any business can be active, or I should say non-passive or passive. And it's strictly dependent on your involvement. It's called material participation. Okay. So for an example, let's say, you and your brother open up a restaurant and, he's there every day involved and materially participates in that activity, and you're not. You just give him the money and you just want to collect the money, when you guys make money. Then the activity is non-passive for your brother, but it's passive for you, right? That's what
Right.
A passive versus non-passive is. And the key term is material participation. There are 7 tests. You have to meet those tests, and that converts one activity from passive to non-passive.
Okay.
That makes sense?
That does.
Now, so to build on top of that, unfortunately, the code says that the rental real estate is always passive, does not matter how much you get involved. Okay, I can spend 1,000 hours a year in one property and it's still going to be passive unless we can qualify as this real estate professional status. And that's where the kicker is, right? It's always passive, but if we can qualify as a real estate professional status, we can harness the losses from rental real estate and offset your W-2 income, which is the end goal for most of the investor from taxation perspective. So to sum this up is every business is going to be passive or non-passive. Rentals are always passive. So just like any other business, if you go and just participate in that activity, you cannot convert rental activity to non-passive. You have to first qualify as a real estate professional, then you can do other things to convert it.
All right. So what are the rules? So if we're going to qualify as a real estate professional, what do we need to do?
Okay. Now this is where the complication starts, right? And I want to mention this before I get into the rules. There is a misconception that people say, hey, I'm going to qualify as a real estate professional and everything, my rentals are going to be non-passive. That's not correct. So the rule we're going to talk about right now just makes you qualify as a real estate professional. Once you qualify as a real estate professional, then you have to materially participate in that activity to convert it, the rental from passive to non-passive. That's why it gets so complicated, and there's so many rules. But I want to make it simple. First step is to qualify as a real estate professional, and then we'll talk about second step.
Okay.
So let's talk about the real estate professional status, right? Basically, you have to meet two tests. First is more than 50% of your personal service performed in the year in all trader business has to be in real estate. That's the first test, and we can expand on that later on. And the second one is you have to spend 750 hours during the year in the real estate trader business, right? For both the test, the activity that counts is again has to be materially participating activity. So it gets complicated there. All you need to understand is if you are spending more than 50% of your day-to-day job on real estate, and that hours sums up to be 750 hours in general, you will qualify as a real estate professional.
Okay.
Does that make sense, Dan?
Yeah. All right. So 750 hours. So what kind of activities count towards that 750 hours?
Perfect. So I'll give you a list of trader business that counts. Okay, it's if you're a developer, if you redevelop, if you have a construction company, or reconstruct, or you go and repair and you have a reconstruction company, if you acquire property, if you convert a property, if you have a rental business, if you have a property management business, if you have a brokerage business, not the mortgage broker, the actual real estate broker, and that also includes the real estate agent, all the agents, and if you sell and buy lands, that also qualifies. So all of these are the actual real estate trader business.
Okay, so it's pretty broad. So you don't necessarily have to be working on your rentals for 750 hours. As long as you're doing something that's real estate related, that's all going to count.
Exactly.
Now, what about if someone's married? Like how does that affect things?
Yeah, so being married really helps you achieve this status. That's the bottom line. Okay, if you have a spouse who also helps you in your real estate ventures, then you can manage the involvement between both of the spouses to meet the rule. However, you cannot. So the test we just talked about, saying 50% of your services throughout the year has to be in real estate, and 750 hours throughout the year has to be in real estate. You cannot count your spouse's hours to meet the requirement. Either you or your spouse has to individually meet those hours. You have to put in the hours. However, I told you before, you can only count the activity that you materially participate, right? Your spouse hours on those activity will help you meet the material participation. So I know this is very confusing. It gets confusing even for professional. All you have to understand is the wives, your wives or your spouses cannot help you achieve that 750 hours. You cannot combine the hours worked by your spouses to meet that 750 hours. But you can count the activity that your wife's works and helps you meet that material participation test on that activity.
Let me summarize and give you my understanding of how the real estate professional status works. To qualify as a real estate professional, there's a couple of things you got to do. The first one is you need to work 750 hours per year in real estate. It doesn't necessarily mean you need to work on your rentals for 750 hours, but you need to be doing something real estate related. Maybe you're flipping houses, or maybe you're an agent. As long as you get that 750 hours in, you pass that test. The other thing is you need to materially participate in your rentals. What that means is you can't hire a property manager and outsource everything and not be involved. You've really got to know what's going on with your rental properties. And then the third thing is you can't have another full-time job. Real estate has got to be your main thing. Maybe you do something else on the side for a few hours here and there, but more than 50% of your work has to be real estate related. So as long as you pass those tests, then you can qualify as a real estate professional. And the way you really benefit from this is if you're married and you have a spouse that has W-2 income. So if you have the real estate professional status and then your spouse has W-2 income, and you can set things up to show a paper loss on your rentals, you can offset that W-2 income and you end up saving a bunch of money in taxes. So that's really the key to making this work. Now, if that seemed very confusing to you and you're not sure exactly how to do this, definitely reach out and talk to a CPA. You don't need to be an expert in this stuff, but the purpose of this podcast is really just to kind of give you a foundation so that you can have a more intelligent conversation with your CPA. If you want to reach out to Ashish, or you're interested in maybe seeing if he can walk you through how to do this, definitely reach out to him. I think that he would be happy to talk to you. You can find him at investorfriendlycpa.com. That's investorfriendlycpa.com. Thank you so much for checking out the podcast today. We'll be back with a regular interview on Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.